So today we'll be talking about the emerging companies limited entity. Obviously it's the listed version of the Australian Small Companies Fund. It's designed to give investors exposure to a cash generative portfolio of smaller companies. What we're looking for is obviously high cash flow businesses and predictable businesses, and we like to buy them at the right price, so supportive valuations. We typically invest in anywhere from 20 to 65 stocks, currently around 35. Our maximum weight, and just from a portfolio risk perspective, is around 5% in any one company. And so that just means we've got a diversified portfolio. But we do have concentrated positions, so we do back our beliefs. The company's consistently paid dividends every 6 months since listing, and the yield currently, I think, is around 3.5% fully franked. Just talk about some themes in the market.
Yeah, thanks, Matt. So Marcus Burns here. So we're sort of going to run through what we're seeing in smaller companies and what we think is interesting in the space, and then Matt will come on a bit later and talk about the philosophy of how we invest. But one of the biggest thematics we've seen in the small company space, in fact, it's been reflected worldwide in many equities, has been a great re-rating of stocks on very high ratings, very high PE ratings. So in other words, expensive stocks have become more expensive, which has actually conversely created an interesting opportunity with more value-based stocks. So what this chart here is trying to show you is that over the last 12 months in the small company space, we went back and ranked all the small companies in the index by the PE ratio, price earnings ratio, and so the most expensive were quintile 5, and the least expensive, or the lowest rated multiples, were quintile 1 and 2. And you can see that over the last 12 months, what's happened to that top quintile, it's had a dramatic re-rating over the last 12 months. So money's flowed aggressively into the stocks that have been the most expensive. They typically are the kind of fintech kind of stocks, high growth stocks, many of the names you'd be familiar with. Some of the WAAAX stocks, so WiseTech, App and Afterpay, some of these kind of names with very high growth in revenue. In many cases, a lot of them don't actually make any earnings or cash flow. And you can see that opposite that, the other quintiles have been sort of left behind, and in some cases, many cases have been sold off to fund more investment in those high growth names. So that's creating opportunities, we feel, in the small company space, and it's how we've been changing the composition of the company or the fund to take advantage of those discounts.
Yeah, so the beauty of that is about 80% of the market looks, there's good businesses in there which are on fair valuations or discounted. Similar to the LIC market, you're seeing discounts relative to NTA, you're seeing a lot of discounts in terms of the real world of businesses out there as well. So that's the opportunity set for small caps.
Another sort of graphical example of that, to give you some sense of just how far that re-rating's gone. Many of you will be familiar with the WAAAX stocks, the WiseTechs, App and Afterpay, Xeros, etc. They're great businesses. Some of them are really well-run companies, but if you aggregate the market capitalizations of those 5 stocks, it's about $35 billion in market cap. But the aggregated earnings are around about 300 million of EBIT. We just contrast that kind of massive multiple, or that massive valuation, with the basket of stocks that we own in our portfolio, comprised of names like KISS FM, which HT1, Breville Group, many guys will know, City Chic, which is a retailer, and Asalio Care. So 5 stocks we own, where the aggregated earnings or EBIT, if you like, is about the same as what the WAAAX stocks are earning, and yet the valuations of those stocks, if you add them together, is about 4 billion. So almost 10% of the valuations we're seeing in the marketplace on the WAAAX stocks. So that coterie of those high growth stocks has been re-rated to an extent that we think is incredibly unsustainable. I'm not saying not good businesses in some cases, we just think the valuations or the multiples that the market's willing to pay for those names is fairly ludicrous currently. So we've been taking money out of those sort of areas and putting it back into areas where we see much better relative opportunities.
I think case in point is WiseTech. It got to a PE of 150 times.
Yeah.
That's I don't think much good happens after 100 times. Probably not much good happens after 50 times, to be honest, but 150 times is pretty much unsustainable. And what you're seeing recently is a big shift. You're seeing a big paradigm shift where those growth companies are coming off pretty hard, and some of the more value names, which are good businesses, are seeing re-ratings. So we are seeing a shift at the moment. Just in terms of performance, so you can see the recent performance of the portfolio. So this is illustrative of the portfolio that we run, that we see, and it's pre-tax and pre-listed company costs. And you can see that relative performance has improved recently. We've actually managed to maintain performance near the index since inception, which has been a difficult task given the fervour for the tech valuations and that sort of tech dynamic that's going on. So we're quite proud that we've been able to maintain performance in a pretty challenging environment, and we think the future's looking pretty bright. In terms of graphically, you can see what the portfolio has done. So the dark blue is the Spheria portfolio. It's up 13% since inception, and you can see the index, which is the light blue. And you can see the disconnect that happened in terms of relative performance. So the green line there is the relative performance. That's the difference between our performance and the index. And you can see recently we picked up quite a bit of relative performance. So we're hoping that that continues. Marcus?
Yeah, it's also worth highlighting that we do have we think the way we invest is actually risk first. So a lot of people look at small caps and say, "Oh, they're fantastic, they're high growth, they're kind of sexy companies, you can make great returns," which is all true. But we approach the small cap space with we want to control the risk that we're exposing our clients to, basically. So Matt talked about our philosophy early on. We look for cash flows and balance sheets and valuations. They're the three things that underpin everything we do at Spheria. And that typically means that when the market sells off or very high stocks get sold off, we tend to do better relative to the marketplace. So our volatility, which is a fancy term for how much the portfolio wobbles around compared to the market, or the beta, they're the two measures that people use as a risk assessment on portfolios. In both cases, we typically have much lower risk metrics in the marketplace. I think that's really key to how you should be getting exposed to the marketplace. If we can give you lower risk and better than market performance over time, we think we're adding value to what you could do as investors in the small company space. And certainly in that sell-off, you can see there in November last year, the market was down, I think, 10 or 11% over that period of time. We were down like 6.5%, 7%. Still obviously fell with the marketplace, but much less than the marketplace. So our drawdowns are typically more muted than the market, simple market exposure would give you. And that's something we're kind of proud of.
So just philosophically, and just to provide an illustration of how we invest, if we look on the left there, you can see a chart of Certex. So Certex is a biotech company. It develops had a liver cancer treatment. You can see the dark blue bars are the cash flow that Certex generates, and the light blue is the earnings that Certex generates over time. And you can see the high cash flow conversion for what is a biotech company. So it's a fantastic business, the sort of business we're after is a high cash flow business. We don't want to pay over the top for it, but it was a good business, had good growth prospects. You can see the earnings and the cash flow growth over the years. It did go through some challenges a couple of years ago, and that provided the opportunity for us to actually buy in at a very reasonable valuation. So we started buying the company at about $12. It had fallen from $50 to $12, and it had come back to a very reasonable multiple. So I think it got down to 10 times free cash flow effectively. It had $120 million of cash in the bank. But that's the sort of company we're looking for. It's going through some challenging times. Still, the growth outlook was strong. The cash flow generation was very good. Now, if you move to the chart on the right, you can see Mesoblast, which is another biotech company. And you can see the red. I mean, the red is the cash flow that it's consuming. So this company burns about $100 million of cash a year. It's investigating stem cell treatments and therapies. And look, we hope that one day it gets there, but at the moment it's spending a lot of money and it's not getting that far. Now, when we invested in Certex, it actually had the same enterprise value, so the same valuation as a Mesoblast. Yet Certex was generating, say, $70 million of cash flow versus Mesoblast burning $100 million of cash flow a year. So anyone with any logic, any sort of reasonable logic would have seen this scenario and bought Certex. But the market has a fascination with cash-burning companies, and we've seen that for a number of years now. I don't understand it, but at some point it's going to come unstuck. We made quite a bit of money out of Certex. It was taken over eventually for $33.60. So we made significant money out of buying a real business that generates real cash flow rather than buying the company that is speculative. In terms of portfolio now, because obviously Certex has been taken over, so it's not in the portfolio anymore. We own a company called Blackmores. Everyone would be familiar with the company. It's the leading supplements, vitamins company in the Australian market. It also has a very high growth Asian business. China has been problematic for the business. They've had a strategy there that hasn't worked out so far, but there is strong growth potential in China. Where they're seeing good growth is outside of China. So the actual business outside of China in Asia is actually nearly dwarfing the Chinese business. But a company with strong growth prospects, a number one player in this market, number one player in Singapore, Thailand and Malaysia. Unfortunately, the problem that Blackmores has had has been self-execution. So if you look at the cost and the margins in the business, the margins produced by the business are around 13.5%. That's the same as it was 5 years ago. So they were doing 13.8% thereabouts 5 years ago. yet the sales have doubled. And that growth in sales has been mostly organic, so they've doubled their sales or more organically, and yet the margins haven't improved. Now, if you look at competitors in the space, competitors are generating margins in excess of 20%. In one case, Swiss, which is their main competitor, generates margins over 30%. Now, if Blackmores can get the cost equation right, we believe it can earn substantially more. We don't think the market's pricing for that at the moment. The market is pricing for this company to generate a margin in the low double digit. So we think there's an upside story here. We still think there's good growth in the business, and we think most of the market has actually left the register. So I don't think there's a lot of institutional investors on the register, but we actually think the outlook for the business is very good and the valuation is very appealing at the moment. So it's one of our bigger holdings. We think that there's a new CEO in there, there's a new strategy, and we think as that evolves, I think the market will be more receptive to the company. In terms of company positions, and we do have a fairly diverse portfolio, you can look through those companies and see a number of brand names that you would know. Some you probably don't. Some are in different stages of their life cycle, so some are going through turnaround situations, some are on a growth path, but we actually think the portfolio is shaping up pretty well going forward. A lot of these companies have been left behind in the rush for that tech, for those tech companies and those tech valuations, which are really stretched. So we think there's very good prospects for the portfolio from here out. And as I said, we're starting to see a significant turn in the market. We're seeing a shift from those high growth names into the more value end of the market, which is where we're playing.
Yeah, and just to add to that, we spoke a bit before about good balance sheets. I mean, 6 out of those 10 stocks have net cash balance sheets. All of them generate good cash flows, and we think all of them stack up from a sort of, fundamental valuation point of view. So that's the kind of thing you're getting with Spheria, and we think over time that'll give you really good returns with less risk in the marketplace.
In terms of outlook, the value end of the market is definitely very attractive at the moment. We're still finding good opportunities in that space. We have been the beneficiary of M&A activity. We expect that going forward as well, because what we look for is cash flow, what we look for is valuation, what we look for is strategic position. That's generally what the buyers of assets are looking for as well. So we do see a lot of takeovers across the fund, which can add a lot of value to portfolio performance. I think we've probably had half a dozen takeovers in the past 2 years across the portfolio. The other aspect of the market that we're liking at the moment is some of the more economically sensitive names. So some of the more building construction type names and household exposed companies are trading at very low valuations at the moment, and we think they're offering very good value. So we're playing that macro dynamic in terms of improvement in the housing cycle and the housing market, and you can see that in our portfolio. So we definitely see a good future for the fund, for the portfolio over the next couple of years. We think the interest rate cuts here will drive consumer spending, and we think the companies that we own will be beneficiaries of that.